In our last video, we left you with a cliffhanger, the new project. This is the full of it problem. Again, you work as a financial manager of a natural fertilizer preparation and packaging plant. The firm is introducing a new product, which, although natural, is also packed with added plant nutrients such as minerals and vitamins. To convey the message of high-content fertilizer, it goes by the name of Full of It. Full of vitamins, of course. This new product is only going to be offered over a 5-year period. To produce this new fertilizer, you'll need equipment that will cost $150,000, and you'll have to fork out $20,000 more just to install it. In addition, you're going to need to buy a whole bunch of inventory, $6,000 worth of crap. Your research has led you to believe that you can sell 25,000 bags of high-content natural fertilizer for $9.50 per bag per year. The cost of the contents, packaging, and shipping are expected to be $4.50 per bag. The annual fixed costs of the venture are expected to be $40,000. For simplicity, we're going to assume, in this instance, a straight-line depreciation where 100% is depreciated over the life of the project of 5 years. And furthermore, the cost of removing the equipment will approximate the value of the equipment at the end of the project. In other words, we're going to salvage for a certain amount of money, and that's about exactly the same amount of money it will take just to get rid of the equipment. So it's going to be worthless on the books, and as far as cash flow basis, it's going to be worthless anyway. We're going to assume a tax rate of 34%. We will also assume a weighted average cost of capital of 15%. Our question is, should we adopt this new project? The answer to this question is, let's figure that out. This is an awful lot of information, though, so how in the world do we get started on it? My suggestion with any of these is break the cash flows down into those three components. Remember, when we talked about these, we said incremental cash flow can be classified as initial cash flow, that's the stuff that comes at the beginning. Operating cash flow, that's the stuff that goes T1 through Tn. In this example, that would be T1 through T5 because we have 5 years. And then terminal cash flows, which are just the cash flows at the end. So I'm going to break this down, and we're going to go look through and see if we can figure out what these look like. So initial cash flows are cash flows that occur only at the start of the project's life. If it's a replacement decision, we'll also have to look at the disposal of the old equipment, but this isn't. This is a new project. Include any net change in working capital, accounts receivable, inventory, etc. With this brief review, let me zoom ahead, fast forward to the problem. So we're going to be looking at anything that happens at the beginning of the project, and we're going to be looking for working capital, current assets minus current liabilities. So, working our way through this, which ones of these are happening at time zero? What do we have to do at the very beginning to get this thing up and running? As it so happens, this whole story problem has a paragraph that focuses almost nothing on nothing but initial cash flow. So we're looking at $150,000 cost of the new equipment, plus the $20,000 installation, plus an increase in inventories of $6,000. Now, it didn't say anything about accounts receivable. It didn't say anything about accounts payable. So we're going to assume that those are zeros. We're not going to increase either one of those. That means that we're not going to sell any of these on account. We're going to sell all of this high-content fertilizer for cash only, number one. Number two, that also means that we're not going to buy any of the inventories on account. We're actually going to have to pay cash for them at the time we pick them up. That's what that means. We do have inventory because we can't sell from an empty shop or an empty shelf, so we're going to have an inventory of $6,000. So how do I get this started? I'm going to get this started by creating all three components in Excel. So I'm going to start at the very top here and say initial cash flow. There was equipment. There was installation. And because I know I'm going to be doing depreciation later on, and that the depreciable base, according to the lecture, was the equipment plus installation plus anything that it'll take to get it up and running, I'm actually going to give myself a subtotal here that says depreciable base. I'm now going to skip a line and say inventory. Skip another couple lines. Well, no, I can just drop down one and then say initial cash flow. So the equipment was $150,000. The installation was $20,000. I'm going to underline that and sum. The inventory is 6,000. And now I'm going to do something a little screwy. Because for the initial cash flow, the sign is important. I've listed them all, but I want to get the sign right. I have to look at if this is an inflow or an outflow. If it's an inflow, then it's positive. If it's an outflow, then it's negative. So I'm going to actually say the initial cash flow is equal to a minus depreciable base plus a, well, actually, I guess I could just say minus the inventory. So I'm going to have to pay for all of this stuff up front, and it's going to cost me $176,000, and it's negative. That brings me back to the problem. But more importantly, I need to break this into the three components. So we've already done initial cash flow. Let's move back and take a look at operating cash flow now. Operating cash flow. With this, we're going to represent incremental operating cash flow as a result of the adoption of the project. With this, we're just looking at what happens as we operate this puppy. What we're going to do, in essence, is look at the change in cash expenditures. These are incremental, but remember, this is a new project, so all cash flows are incremental. It's just going to be revenue that we would get minus current revenue in this area, which is, well, 0, and it's going to be everything minus, well, 0, because we're not doing any of it. So we're going to look at change in cash revenue, change in expenditures. In other words, we're going to look at revenues minus expenditures minus taxes, and then we're going to have to also take a look at the effect on the cash flow. And with cash, we're going to be looking at total revenue, total expenses, total tax. Then we're going to add back the depreciation and get the cash flow estimate. So again, we're just looking at an income statement kind of thing with all the operating cash flows. Based on that story, we're looking at the 25,000 bags of high content natural fertilizer at $9.50 per bag. Then the cost of packaging, shipping, and all of the variable costs would be $4.50 per bag. The annual fixed cost of the venture would be $40,000 fixed cost. For simplicity, we're going to assume that the whole thing is going to be depreciated over the 5-year life of the project using straight line depreciation. So we're only going down that far in our story problem, and now we're going to create what's going to look like an income statement, and then we're going to add the depreciation back at the end. So here we go. I'm going to move over to the side and say now I'm looking at operating cash flow. We're looking at the demand, and we talked about 25,000 bags per year. Whoops. Revenue per bag is assumed to be 9.5 and the cost per bag is assumed to be 4.5. Now we're going to do a very simplified version of an income statement by saying what are the total revenues, and then what are the total cost of goods sold, so we're just going to take the 950 multiplied by the 25,000 and we get a nice small number. Haha. And then with the cost of goods sold, we're going to say is equal to the 450 times the 25,000. Actually, I don't even need it to be that. And then we're going to underline, say gross profit. Then we're going to go into the operating expenses, which I'm just looking at fixed overhead. Whoops. Which is 40,000. You know, I'm tired of doing this. Okay. And now depreciation. Depreciation is going to be the depreciable base, and since it's straight line, I'm going to do that divided by how many years, which is 5. So we're going to say equals that number divided by 5. So I'm going to sum those. Actually, let's do this. Let's say operating profit. Actually, I didn't ever finish my gross profit, so let's get my gross profit done, which is revenues minus cost of goods sold. Operating profit would be gross profit minus the sum of those, and I get 51,000. Then we have taxes. By the way, usually we would put interest in here, but again, interest is, we're going to take into account interest in the weighted average cost of capital, and after-tax interest is already taken into account. We're looking at the after-tax cost of debt. And because of that, we don't have to take into account the interest before we take out the taxes, which we usually would do. I'm hoping that makes some sense, but who knows whether it does or not. So we're going to take the 34% times the 51,000, and then we'll get net profit. Now this is not the cash flow, but this is the first step in getting there. So we're going to say equals 51,000 minus the 17,340 gives me a net profit of 33,660. But the operating cash flow is going to be equal to the net profit plus depreciation, because it had nothing to do with cash. All it does is shield me from tax. So I get operating profit of 67,660. Now that's per year. So let me put out here annually, just so we get the fact that that's an annual payment, so to speak, of cash. What we're going to do now is look at the terminal cash flow. And again, we're going to be looking at these all separately by going back and looking at the concept, applying it to the example, and seeing if we can figure out how much there is going to be there. We've covered most of this story problem already, so you're saying what more could we possibly pull out of there? Well, it says, furthermore, the cost of removing the equipment will approximate the... So we're not going to get any salvage out of it in cash. And since it was worth 0 on the books and we get 0 from it, there's no tax effect either, which is actually a simplification, which is nice. We don't have to deal with that one this time, thank heavens. Don't worry, on the next one I'll show you how to deal with that. So, is there any terminal cash flows? Let's look at my little cheat sheets on what should be in terminal cash flows. Terminal cash flows are those cash flows associated with winding the project down. Terminal cash flows should include final disposal of the project, so we're getting rid of the equipment, salvaging it, removing it, and any tax effects. And we figured that those were all zeros. We're going to get nothing for it after removal, and therefore the tax effect is also going to be 0. So, bully for us. And then return the firm's operations to normal, including returning working capital to normal levels. Remember, right up front, we increased our inventory by $6,000. At this point, we're needing to sell off all of that inventory and not replace it, which basically means we're going to pull out that $6,000 initial investment now at the end. It's this last item, the returning of the firm's operations to normal, including returning working capital to normal levels, that we need to make an adjustment on for this particular project, even though it's not specifically listed in the problem. Notice it doesn't say anything about it. The fact that we had to increase it to begin with, and the fact that it's only a 5-year project, implies that at the end of that time period, the amount that I invested in inventory, I'm going to be selling off and recouping that investment. So this is the easiest part of the whole story problem, so let me pop over to Excel and show it. So terminal cash flow, I'm going to be looking at inventory at 6,000. Now the one thing to note right up front is all the initial cash flows happen just one time. The operating cash flows in this instance are annual, so we're assuming that they're repeated every single year. So it's 1, 2, 3, 4, 5 years worth of the 67,660. And then at the end, the terminal cash flow only happens once. At 6,000, we only get it back once. The other thing to note is the signs. Initial cash flow of negative 176,000 because I'm having to invest that up front. And then the positive 67,660 for 5 years comes in positive. I actually get cash flow coming in. And then at the end, I get my $6,000 back. So those signs are critical. We have to do those correctly. Having said that, I'm going to pop down to the bottom here and actually create what's going to look like a table, but sort of a cross between a table and a cash flow timeline. So I'm going to make some room, and what I'm going to be looking for precisely, actually let me move maybe here, well no, here. I'm going to say T0. And I'm going to go up and highlight my 0 and subscript it. I'm going to hit enter so that it does it, and then I'm going to center. I'm going to grab the little corner here and pull it across until it says T5, and you'll note that they're all T and subscripted 0 through 5. I'm going to say initial cash flow, operating cash flow, and terminal. Yeah, I know. I'm not doing my Arnold imitation. I'm figuring it probably got old anyway. So then I'm going to say equal. Initial cash flow only happens once. The operating cash flow, I'm going to say equal 67. Whoops, I'm in the wrong column. If we remember correctly, it says that these occur T1 through Tn, so I have to be in the right column for T1. I'm going to now go up and hit the 67,660, and before I hit enter, I'm going to hit F4 because I want to copy that same number all the way across. I'm going to pull that all the way through T5 because that's what it says. Remember, that's the concept. We're getting this one, we're going to have to pay that one out, then we get these back over time, and then at the very end I'm going to get the 6,000, and just so that I can see what the cash flows are going to look like, I'm going to draw a line there and then say give me a sum. You're saying, why are you summing just one thing? Well, for the most part it's one thing, but here in the end it isn't. Now, to make this into a true capital budgeting problem, I have to say, what is my weighted average cost of capital? Actually, let me move this over. What is my weighted average cost of capital? And I'm going to say it's 15%, because it is in the problem. Based on that, what's the net present value, what's the internal rate of return, and what is the modified internal rate of return? Just so we can remember how to do these, we're going to say equal NPV, and the very first thing it asks for is the rate. That's the weighted average cost of capital. And then it wants values 1 through n. 1 through n, notice we don't include the first one. Close parenthesis, add that initial outlay, and we get a big number with way too many decimal points. This is one thing that drives me nuts about Excel. They have not fixed that yet. IRR is equal IRR. Just highlight the whole thing and hit enter. Finished. And give myself a couple of extra decimal points. MIRR is equal to MIRR. Wants the values. There are the values, comma, how much would I finance it at? 15%. What would I reinvest it at? Well, at least 15%, so I'm going to put that for both. And then hit enter. Give myself a couple of extra decimal points. Now, the thing to note is if this one is positive, then we should say adopt the project. Well, it is positive. It's greater than 0. And IRR, I would be making more than the 15%. Even with the modified internal rate of return, I'm making more than the 15%. So the answer is adopt the project. I'm hoping that made a whole bunch of sense. The big problem with this story problem is getting to here, because once we get to here, we just plug it in to the stuff that we did in the last chapter, and it's a done deal. Recapping. NPV 53,789.87. IRR 27.16%. MIRR 21.30%. Adopt the project. Now I need to get you onto another cliffhanger here, and here it is. Replacement example. This one's a little more ugly. It looks like it's shorter, but it's really uglier, okay? The company is considering the purchase of a new packaging machine. The old one is currently being depreciated at $10,000 per year straight line and is scheduled to end in 5 years with no remaining book value. If you don't replace the new machine, you will be lucky to get it removed for the amount you could salvage it for, so you don't expect any profit in 5 years. If you do replace the old machine now, you believe you can salvage it for $40,000 net of removal costs, so you'd come out $40,000 ahead, and buy a new machine for $160,000 plus $12,500 shipping fee and another $10,500 for installation. The machine will reduce the operating costs of the company by $75,000 per year. The new machine will be depreciated using the 3 years modified accelerated cost recovery system, and it says for simplicity purposes, but that actually makes it far more complicated. The useful life of this machine is 5 years and is expected to yield $1,000 in net salvage value at the end of the 5 years. Again, you may assume a tax rate of 34%, and again, we're going to assume the 15% weighted average cost of capital. This looks simpler. It's far more complicated, and we'll show this to you in the next video.